Our first topic today is the Affordable Care Act, and our speaker is Tia Bonkowski. Tia is a senior manager at Rehmann with more than 15 years of experience in the accounting field. She provides accounting, consulting, and tax services to closely help businesses, not-for-profit organizations, and high-net-worth clients. Tia is also skilled in handling multi-state taxation issues. Okay, Tia, whenever you are ready, you may begin your presentation.
Good afternoon, everybody. Thanks for joining us. Today my task is to inform you of some key ideas and concepts about what you need to know for ACA for 2015, filing requirements, and what's coming up in 2016. So the topics I'm going to cover today are some key concepts, key employer requirements, 2015 reporting requirements and deadlines, some 2016 Affordable Care Act changes and some current legislation that could affect what happens in 16, and 2015 and 2016 potential penalties to help you avoid those. So to start out with some key concepts, major key concept is applicable large employer. And what that means is it's an employer with 50 or more full-time and or full-time equivalent employees. Full-time equivalent employees are part-time and variable hour employees combined together using various measurement options to determine the number of full-time employees that you have. This calculation can be very, very complicated. So if you need help, you can always contact us at Rehmann and we can help you determine if you are an applicable large employer. Another key concept that's very important to know is the control group concept. Businesses with common ownership must combine employees to determine if they are considered applicable large employers. So even if each business individually has less than 50 full-time and full-time equivalent employees, they still must offer minimal essential coverage with minimal value to full-time employees if the combined total of full-time employees and full-time equivalent employees within the different businesses is equal to or greater than 50. The requirement to provide insurance is based on full-time plus full-time equivalent employees. So you must offer insurance to full-time employees even if you have less than 50 full-time employees, if you have a total of 50 or more full-time plus full-time equivalent employees. So if you need help with determining if your businesses are a control group, or if you need help with the calculation of whether or not you are an applicable large employer, please contact me and I would be happy to help you out with that calculation and determination so you know what your filing requirements are. So some key employer requirements at a glance. Employee notice requirements. At the time of hire, employers must notify employees whether or not they are offered health insurance and whether or not the employee is actually eligible to get insurance through the company. An applicable large employer must offer affordable coverage that provides minimum value to full-time employees and their dependents. And dependents does not include spouses, but it does include kids up to age 26, which is relatively new. Eligible employees must be offered insurance within 90 days of their start date. Applicable large employers are required to file annual reports providing information to the IRS and employees regarding employee health coverage, and that's you might have heard of the 1094s and the 1095s. We'll get into that more specifically later. Self-funded group health plans of any size must file annual reports to the IRS and employees regarding health coverage. So even if you don't qualify as an applicable large employer, you might have 5 full-time employees, you're still going to have a filing requirement. For 2016, health insurance coverage must meet cost-sharing minimums, which means that an employee's in-network and out-of-pocket maximum costs, which includes co-pays, co-insurance, and deductibles, cannot exceed $6,850 for individuals and $13,700 for families. If employers are required to file Forms 1094 and 1095, Forms are due to the IRS by February 28th if filing on paper, or March 31st if filing electronically. However, the forms are due to the employees by January 31st. So that's a very important thing to know. I've had some clients think that they had till the extension of their business return, and that is not the case. We have available an ACA reporting decision tree to help you determine if you have a reporting requirement. I'm going to go through a lot of this on the next few slides. If you're interested in getting a copy of this, please feel free to email me and I'd be happy to send you one. So for 2015 employer 1094 and 1095 filing requirements, employers with less than 50 full-time employee equivalents do not have a filing requirement unless they offer health insurance through the self-insured employer-sponsored health plan, as I indicated before. So employers with the self-insured plans must file forms 1094B and 1095B with the IRS and issue form 1095B to the employees. For applicable large employers with greater than or equal to 50 full-time equivalent employees, there's a couple of different scenarios. If you're an applicable large employer with self-insured plans, you're going to file forms 1094B and 1095B with the IRS and file form 1095B to the employees. There are additional filing requirements for non-employees like directors and former employees, which are on the decision tree. If you have those issues, you can contact me and I can help you determine how to do those filings. If you're an applicable large employer with an employer-sponsored health plan, you're going to file forms 1094C and 1095C parts 1 and 3 with the IRS and file forms 1095C with your employees. There is a simplified statement that you can send to your employees, but it seems to me to make more sense since you're already providing the information with the IRS on the 1095C that it's probably just as easy to do the 1095C for the employees. And again, with the employer-sponsored plan, you may have some additional filing requirements for non-employees like directors and former employees. If you have those situations, please contact me and I can help you out with that. Employers with no health plan still have reporting requirements. They need to file forms 1094C and 1095C parts 1 and 2 with the IRS and provide form 1095C parts 1 and 2 to the employees. So this would be, did you offer them insurance and they declined, or did you not offer them insurance? So if you need assistance with filing these forms, because it is a very large task, Rehmann has a solution for employers to help you with the filing requirements. We can help you determine if you have a filing requirement, and we can actually help you prepare for the filings. If you need assistance, please contact me immediately. We need to get the process started quickly. Preparing the reports, there's a lot of information that we need to get from you. It's very time-consuming and extensive, so we need to start right away. And if you want us to do that, we're going to have to start that process by December 15th in order to get it done timely and get everything filed properly. So for 2016, there's 6 basic changes with ACA. The first one's a little bit confusing because there's a new definition for small employer, but it's not changing the requirements for your filings of your 1094s and 1095s. It's really only for insuring purposes. So until 12/31/2015, small employers are defined as 50 or fewer full-time equivalent employees. As of 1/1/2016, the definition changes to include 1 to 100 full-time equivalent employees. So what does this mean for you? If you're an employer with 50 to 100 full-time equivalent employees, you'll now have to meet the requirements for small employer groups with the insurance companies. So unless the only caveat being unless you have an employer-offered grandfathered-in plan that covers essential health benefits and meets the rating requirements. So that being said, for the small employers, the premiums are estimated to increase 18%, so that's no good. A lot of this is going to cause some employers to consider going to the self-funded plans, and when that happens, that could further increase the premiums for those who don't go with self-funded plans. On a brighter note, sort of, the Senate and House passed the Protecting Affordable Coverage for Employees Act, which actually, since this presentation was developed, was signed by the President. So what that did was amend the definition of small businesses and protect them from the possible increases from health care premiums under the Patient Protection and Affordable Care Act. So as far as the federal government is concerned, we revert back to the 50 or fewer full-time employee equivalent as the small employer definition. However, the legislation allows states to determine if they want to expand that definition to cover up to 100 employees. So we're still waiting to see what the states are going to do, but depending on what state you're in, the definition may be different. So we'll have to stay tuned on that one. Employers with 50 to 99 full-time equivalent employees will be considered applicable large employers for the employer mandate penalty. They're required to offer minimum essential health coverage that is affordable and provides minimum value to 95% of full-time employees and the dependents up to age 26. For 2015, the requirement was applicable to employers with 100 plus full-time employee equivalents. In 2016, applicable large employers, which is 50 employees plus, must offer to 95% of full-time employees compared to 70%, which was required in 2015 to avoid penalties. These employers must pay a penalty if full-time employees receive a tax credit or a subsidy through the marketplace if the employer-provided insurance was unaffordable or did not meet the minimum value. So you may have somebody, one of your employees that goes to the marketplace, they decide that they don't want the coverage that you're offering, they end up getting a subsidy or credit. That's going to generate a notice. From there, we would correspond with the IRS to show them where's your employee actually offered affordable coverage, did it meet the requirements, and they chose to go to the marketplace. If that's the case, the employee is going to be the one with a penalty. If it's not the case, then the penalty would be on the employer. So as far as penalty calculation goes, there's changes from 2015, there's phasing in. So 2015, when calculating the penalties, the first 80 full-time employees are excluded from counting towards the fee. And in 2016, that reduces down to the first 30 full-time employees being excluded. Starting November 15th of 2015, employers with 51 to 100 full-time equivalent employees can use the SHOP marketplace, so the Small Business Health Options Program. The SHOP was previously only open to employers with 50 or less full-time equivalent employees. And in order to get the health care credit, you actually have to purchase from the SHOP marketplace. So that could be of benefit to some employers. In 2016, the annual in-network out-of-pocket maximum cost, as we discussed before, deductibles, co-pays, co-insurances, allowed before health coverage starts, increases for individual coverage to $6,850 and for family coverage to $13,700. But the maximum for each individual employee or dependent is $6,850 before the family coverage kicks in. So for 2015 and 2016, there's penalties for failing to meet the applicable large employer reporting requirements. And you'll see in the next few slides, the penalties go up with the, the caps increase. And you may have heard this term pay or play penalty. It is the employer mandate. So applicable large employers must offer affordable and adequate insurance coverage, adequate being minimal essential coverage and minimum value to their full-time employees and their dependents. If you are an employer with less than 50 full-time equivalent employees, there's no penalty for failing to offer coverage. If you are an employer with 50 to 100 full-time employee equivalents, there's no penalty for failing to offer coverage in 2015 if the requirements of transition rules are met, but you'll be subject to pay or play penalty in 2016. So if you think that you may meet requirements or hope you meet the requirements of the transition rules, please contact me and we can go over your situation and determine if that's the case for you. If you're an employer with 100 plus full-time employee equivalent, full-time equivalent employees, you're subject to the pay or play penalty in 2015, and you must offer coverage to 70% of full-time employees for 2015 and 95% of employees in 2016 and future years. So even one employee going to the marketplace and receiving a subsidy or a credit on their tax return triggers the pay or play penalty. So it may be the case that you start getting notices after October 15th of the following year, because that's when the IRS is going to see the individual employee's tax returns, and you may get some notices that will have to be responded to. In 2015 and 2016, penalties for failing to meet applicable large employer reporting requirements will go up as will caps. So the pay or play penalty, there's two parts to it. There's a big penalty, and that's for not offering coverage to required number of full-time employees. The penalty is $2,000 a year, and it's calculated on a monthly basis at $166.67 per month per employee, multiplied by the number of full-time employees in excess of 80 for 2015 and in excess of 30 for 2016 and future years. So they cut you a little break. The small penalty is for offering coverage to required employees, but the coverage is not affordable and or it doesn't provide minimum value. And that penalty is $3,000 a year, also calculated on a monthly basis at $250 a month, multiplied by the number of full-time employees who obtain a premium tax credit from the exchange. And this small penalty can't exceed the big penalty amount. And then just to reiterate, coverage must be offered by the first day of the 4th full calendar month of employment for your full-time employees. And that is the information that I have for you today. We will have Q&A later in the session, as Rachel has indicated.
Thanks so much. Thanks so much, Tia. That is really great, timely information. So we really appreciate you taking the time out of your busy day to come speak with us today. And as Tia just mentioned, we will have a Q&A session, 2 of them here in the next couple of minutes, or excuse me, next couple of presentations. So if you do have any questions for Tia, please go ahead and submit those through the chat box. In the meantime, we're going to go ahead and continue on with our next presentation, which talks about tangible property regulations. And our speaker is Ryan Whitman. Ryan is a senior manager within Rehmann's tax department and works with clients in a wide range of tax and consulting areas, as well as overseeing several of our bookkeeping engagements. His experience includes serving closely held business clients in both real estate and construction. Okay, Ryan, whenever you are ready, you may begin your presentation.
Thank you, Rachel. As Rachel said, my name is Ryan Whitman, and I'm a senior tax manager in the Toledo, Ohio office of Rehmann. So about a year ago, I started going out and meeting with clients to go over the tangible property regulations and how they would impact their business, what opportunities we had, what work we had to do. The first question I got when I went out there was, Ryan, companies have been capitalizing things ever since the first wheel was put back on the books back in the Stone Age. Why are they changing things? What's going on? Well, it goes back to companies were incurring expenditures to, well, repair or improve assets, and they were expensing them. Well, the IRS, of course, was not a huge fan of that, so they started going to court. This led to a variety of different decisions across the country on what should be capitalized and what couldn't be capitalized, and left the taxpayers in a big gray area, not real sure what to do. So the IRS sprung into action and said, we're going to write some rules and we're going to clarify this. So that was in January of 2004. In 2006, they came out with proposed regulations. That's right, 2 years. Those were withdrawn. So 2 more years go by. In 2008, they come out with another set of proposed regulations. Those were also withdrawn. So now the service has learned from their mistakes and decided that clearly 2 years is not enough time to write these rules. So they wait an extra year. They come out with some new proposed regulations in December of 2011. Lo and behold, 3 years was the magic time period. Those regulations go final in 2013. That's right, this saga started in January of 2004 and went final in 2013. It's like a Star Wars saga with less spaceships and probably less Wookiees. But here we are. So where are we at now? Regulations were effective for tax years beginning on or after 1/1/14. So if you're a calendar year taxpayer, you would have dealt with this last year on your return. If you're a fiscal year taxpayer, maybe you've already done with it, maybe you're in the middle of it, maybe it's to come. But so what did we do in 2014? We reviewed your prior assets already being depreciated. So that was the second issue when I was going out to clients, was how far back do I have to look at my fixed assets? 1 year? 2 years? Surely it can't be any more than 5 years. Well, the answer is you have to go all the way back. So you could go all the way back in time, and if you're one of those companies that has the wheel on your fixed asset run, that was something we wanted to look at. We also reviewed your 2014 activity to make sure everything was being treated properly. A lot of these required change of accounting methods. Those were the forms 3115 that a lot of you saw. And then there's various appropriate elections that needed to be filed with the tax return. Now those were the general rules. There was a small taxpayer exclusion. And I included the authority for those of you who are just dying to know what it is in case you want to look it up. It was Revenue Procedure 2015-20, which came out in February of 2015. This allowed you to adopt the tangible property regulations without filing 3115s. The catch was you had to adopt them on a prospective basis. So there was no opportunity to look backwards at your fixed assets to figure out if there's items on there that perhaps shouldn't be. This may have led to some missed opportunities if you adopted the small taxpayer method without fully looking at it. This applied to what the IRS determined to be small taxpayers. So we're talking about companies with gross receipts less than $10 million on a 3-year average, or total assets less than $10 million. So I just told you that these rules were effective 1/1/14, and a lot of you probably dealt with them on your return last year. So the question you may have sitting there is, why is this still important? Well, there's 2015 additions to consider. There may be things that you've capitalized for books that you don't need to for tax under the new regulations, and vice versa. There's various things where we need to make sure book and tax are consistent, so we want to make sure those are properly aligned. There's annual elections that need to be made, and there's perhaps partial asset disposition opportunities. So the main issue with these is, what am I going to do with these costs I've incurred to repair assets? And the million-dollar question is, capitalize or expense? So before we can even talk about the test, the first thing we're going to have to consider is, what is our unit of property? Once we determine what our unit of property is, we'll have to run them through 3 separate independent tests and determine if what we have done is considered a betterment, an adaptation, or a restoration. So as I said, the first step is going to be to determine what is our unit of property. We're going to apply the functional interdependence standard. So can the asset function independent? If it can, it's generally going to be its own unit of property to run the test against. There's special rules for buildings, leased property, plant property, condos, co-ops, and network assets. And the third thing we're going to want to think about is whether our unit of property for tax is going to be different than our unit of property for book. So I mentioned building has its own rules. So the building is not its own unit of property. Instead, the service identified 9 separate building systems as separate units of property to consider. Now, the number one question with buildings is what is the roof? And the roof is going to be considered part of the building structure or the shell of the building. The 9 unit of properties that the service has identified is the HVAC, plumbing, electrical, escalators, elevators, fire protection and alarm, security systems, gas distribution, and you just gotta love number 9, which is the old IRS catch-all. Basically says anything we forgot to put on this list that we decide we want to add later, we're going to add it. So because we have these separate building systems, some things that maybe we think are repairs may have to be capitalized because we're going to be comparing them to something different. For example, if you do a project on your HVAC, if the building was the unit of property, your HVAC work would have to be pretty significant to be material to the building as a whole. But you have to remember the HVAC is a separate building system, so you're going to compare the work you've done on your HVAC to the HVAC building system. So all of a sudden your materiality becomes much more relevant, and you really got to consider what you've done there. So I said there's 3 independent tests to determine whether an expenditure is going to need to be capitalized. The first of those tests is the betterment test. The betterment can be to fix a pre-existing condition when you acquire the property. This is going to be really important to think about if you're buying used assets. You buy a used piece of machinery, requires significant cost up front to get it back in its shape to go out onto your floor. Those costs are very likely going to be considered betterments because they're cost to bring it up to standard, and you're going to have to capitalize them. The other 2 kind of come naturally with the description of betterment, result in a material addition, or result in a material increase in capacity, productivity, efficiency, strength, quality, or output. Now, just because you're replacing it with something better doesn't necessarily mean that it's a betterment. Replacements due to technological improvements don't necessarily require capitalization. As long as you're replacing it with the commercially available equivalent, that in and of itself will not require it to be a betterment. When you're doing work, the key is going to be to compare the property after you've done the work to when you originally placed it in service. If you're just bringing it back to that original condition, again, that in and of itself won't be considered a betterment. And we can have book tax differences here. You can capitalize something on your books and determine it's not a betterment for tax and expense it, and it could also go the other way around. So building refreshes are not betterments, and I'm not going to go through all these examples on here, but a building refresh is something I like to think of as something cosmetic or personal preference. You know, you're going to paint, patch some holes, replace some ceiling tiles. You're not doing anything terribly significant. Now, building remodel, on the other hand, is going to be considered a betterment, and this is when you're really doing something pretty significant to the building. You know, replacing walls with windows, replacing the flooring with an upgrade, upgrading the electrical system, those types of things. So as part of the regulations, the service gave us a bunch of examples on things that are betterments and things that aren't betterments. So I'd like to go through a couple of them that I think are of note. Something that's not a betterment is the replacement of asbestos insulation with similar non-asbestos insulation. Now, on the surface, that certainly sounds like a betterment to me because I would much rather be in an environment with non-asbestos than with asbestos. But again, now we've replaced something with the commercially available equivalent. So no, you don't have to run out and try to find asbestos insulation in order to avoid the betterment treatment. The roof membrane, the replacing of it, not in and of itself a betterment. And then replacing 2 of 10 HVAC units that are 10% more efficient, not considered a betterment. If you recall earlier, we talked about things that become more efficient being betterments, but they use the word material. So 10% isn't going to get over that threshold. Now some things that are betterments, a retail refresh, so a paint job or something cosmetic, but we're also increasing storage and adding a loading dock. So we're increasing capacity here, so that is going to get over that betterment threshold. And then second to the bottom, a 50% reduction in energy or power cost is a betterment. If you recall from the previous slide, 10% was not a betterment, but 50% is. So when you get in between those thresholds, you're really going to have to look at your facts and circumstances. And figure out whether you have a betterment or not. Adaptation is the second test. Adaptation is when you're really just changing the asset. So you're taking an asset and you're changing its purpose from when you originally placed it in service. Again, the service has given us a series of examples in the regulations of things that are and are not adaptations. I marked a couple of them that I think are of note. Combining 3 leased retail spaces into 1 leased retail space. Sounds like a pretty significant job and something we would have capitalized before. But when you think about the adaptation rules, we had commercial real estate before, we have commercial real estate after. We have the same square footage available for rent after the work as we did before. We've just configured it a little differently. We haven't changed anything. We don't have an adaptation. However, you look across the aisle, convert manufacturing plant to showroom space. Well, we've got the same building serving our general manufacturing purpose. We got the same square footage, but we've changed it. Before we were manufacturing in that space, and now we're using it to showcase our products. So we have changed what it's doing. We go back to the not a change column. See, we've converted a portion of a grocery store space to a sushi bar. Certainly sounds like a pretty big change to me. But when you step back and think about it again, you're selling food for off-site consumption at the grocery store, you're selling sushi for off-site consumption at your sushi bar. You haven't changed anything. You've just gone from selling soups or what have you to sushi. You look across the aisle, reconfigure part of a retail pharmacy to a walk-in clinic. Sounds pretty similar on the surface, but again, when you step back, your retail pharmacy is going to be selling prescriptions over the counter and all the other miscellaneous stuff you can buy there. But now we've changed it to providing some sort of medical services in the walk-in clinic. So we've changed our unit of property, and we're going to have to likely capitalize those costs. The third hurdle you'd have to get over to expense is the restoration. So an amount is going to be considered a restoration if it returns a unit of property to its ordinary efficient operating condition after it has deteriorated to a state of disrepair. So if you recall back in the betterment example, I said as long as you're bringing it back to its original condition, it's not going to be a betterment. But if it's gotten to the point where you can't even use it, it might not be a betterment, but you're going to get hung up under the restoration rules. Kind of among the same lines, rebuilding a unit of property to a like-new condition after its class life is going to be a restoration. Just like the betterment, where we're bringing it back to back to its original condition when you first put it in service, it might not be a betterment, but it certainly could be a restoration depending on how old the asset is. This will prevent you from taking the same piece of machinery and just continuously rebuilding it and expensing it. At some point, they're going to cut that off. Or it could be for the replacement of a part or combination of parts that comprise a major component or substantial structural part. We'll get into some of those definitions in just a minute. The final 3 restoration rules have to deal with replacing part of the unit of property, either in a scrap, a sale, or a casualty transaction. So unit of property, I use the terms major component and substantial structural part. So a major component is a part or combination of parts that perform a discrete and critical function. Substantial structural part comprise a large portion of the physical structure or that perform a discrete and critical function. So this is where in a building a roof is going to come into play. A roof certainly comprises a large portion of the structure, and it also performs a pretty discrete and critical function in the operation of the building. The regulations with this are highly subjective, facts and circumstances. So depending on what you're doing, really going to have to analyze those. Incidental component, even if it performs a discrete function, not in and of itself a restoration. Something off the top of my head would be like locks for the front door. Certainly discrete, certainly critical, pretty incidental to the operation of the building. So we again have a series of examples from the regulations on things that are restorations and things that are not restoration. So replacing the roof membrane, not a restoration. You recall that also was not a betterment earlier. Replacing 100 of 300 windows, comprising 8.3%, not a restoration. Replacing lobby floors, less than 10% of the square footage, not a restoration. Replacing 1 of 4 elevators, not a restoration. And the key to that is that we did not write off the old elevator. So the flip side, the restoration. Now replacing the entire roof is a restoration. Then these window ones, a couple down. Replacing 200 of 300, comprising 16.67 is. Replacing 100 of 300, comprising 30%, also is. If you recall on the previous slide, replacing 100 of 300, comprising 8.33%, was not. Replacing 100 of 300, comprising 30%, is. So again, once you're between that 8.31% and 30%, you're really in a gray area and really need to analyze your facts and circumstances to figure out which way you should go. Also above, the 200 of 300, comprising 16.67. They didn't tell us what the material part is. Is it because we replaced 2/3 of the window now, or is it because we've increased the surface area from 8.3 to 16.6? So you're really going to have to think about the facts and circumstances when you're in those gray areas. Replacing floors in public areas comprising 40% is, again on the slide before, 10% was not, 40% is. We got a pretty big gray zone again. Replacing 1 of 4 elevators and claiming a partial disposition loss is going to be, and that makes sense. You have 4 elevators. If you're going to write one of them off, it only makes sense you have to capitalize the new one. So there's some new rules regarding materials and supplies. Service has defined materials and supplies, generally something with an economic useful life of 12 months or less, or that costs $200 or less, or another one of those great IRS catch-alls, anything we identify later that we didn't put in now. So what have they changed with materials and supplies? They've of course changed when you can deduct them. Incidental materials and supplies, so these are things you're not inventorying, they're deducted when paid. Non-incidental materials and supplies, so these are things you're either putting in inventory or things you're tracking the consumption of. You would deduct them when you first use them or put them into service. Now if you have rotable, temporary, or emergency spare parts, there's some special rules there, and I would encourage you to talk to either myself or your Rehmann tax advisor to make sure you're treating those in the most advantageous way possible. A couple annual things to be aware of: the minimus safe harbor, routine maintenance, and the election to capitalize repairs. De minimis safe harbor, this is an annual election. That's right, an annual election. It will need to be made in the return every year. What this lets you do is deduct expenditures below a certain set threshold. That threshold is $500 or $5,000 if you have an applicable financial statement. Now, an applicable financial statement is generally an audit. There are situations where if the government requires it, it could count, and the government is not the IRS or a state tax agency. So if you're in a situation where you don't have an audit but are supplying it to a government agency, we'd be happy to look in and make sure that would qualify. You also need to have a written policy as of the first day of the tax year. This is one of the areas where the book treatment must match the tax treatment. Now, one of the issues we run into this is that $500 threshold for taxpayers without applicable financial statements. That can capture quite a bit of taxpayers. Anyone from a single-member LLC, maybe selling Mary Kay on the side, all the way to a heavy manufacturer doing tens of millions of dollars a year in revenue that doesn't require an audit for whatever reason. So if you don't feel that that threshold is appropriate for you, you can set a different threshold. You just are not covered under the safe harbor, and you would have to be able to justify to the service why that clearly reflects income for your company, but you can choose a different amount. Now, if you don't have an accounting policy in place or you do not make the annual election, the threshold drops from the $500/$5,000 all the way down to $200. So it's pretty significant to make sure that election is in the return. Routine maintenance safe harbor. So this allows you to deduct recurring activities to keep the asset in its ordinary efficient operating condition. The first thing I always think of with this is oil changes on a car. So you have to expect to be doing these more than once during the useful life or more than once in a 10-year period for a building. This includes things like inspections, cleanings, replacement of damaged or worn parts. Now, the safe harbor does not cover anything that's considered a betterment, restoration, or adaptation. So you still have to consider those tasks. And you needed to file a change of accounting method to adopt this method. The election to capitalize repairs wasn't a super popular election when I'm out meeting with clients, but it's one you might want to consider using. Now, it is an annual election, so you can use it this year and say not next year. You're not all in. And it also doesn't require you to capitalize all repairs and maintenance, just the ones you did. The nice thing about this is if you're in the gray area and maybe want to play it safe and go ahead and capitalize your repairs, go ahead and do it. Put the election in the return. That'll cover you if in the event an agent comes in and starts analyzing whether, in fact, that was a capitalizable expense. You've got the election. You should be covered. Partial asset disposition rule is something new and significant in these repair regulations. The biggest spot we have seen it here is with roofs. So when you buy a building, I hope at least that it has a roof on it. So some time goes by and it needs a new roof. So you put a new roof on. You've got to capitalize the roof because you've done the whole thing. So now you have two roofs on your books. You have a roof part of your original building, and you have your new roof that you just put on. Now, sitting in Northwest Ohio, our roofs traditionally do not last 39 years. So who knows how many sets of roofs you could have on your fixed asset run, all depreciating. So what the partial asset disposition rule lets you do is it lets you go in and break out that old asset and dispose of it when you put the new asset on. So when I'm doing this discussion, I usually get stopped right here and say, how the heck do I know how much that old roof costs? How am I possibly going to determine that? Well, the IRS gave us some great advice and told us that we could use any reasonable method we see. So kind of interesting, but a lot of the methods they've suggested make a lot of sense. What it generally involves is back costing the roof to how much it would have cost. There's a variety of methods you can use to get there. Most of them generally make pretty good sense. So this has led to some planning or maybe some different thinking. A lot of times we see an LLC that owns a building and rent it to a related party that maybe is, say, a C corporation. Traditionally, the C corporation would take care of all the maintenance and expenses for the building. Now, the building needs a new roof. So we would want to think about who's going to put that new roof on. If the C corporation puts the roof on and capitalizes it, they have no old roof on their books because they have no building on their books. So they have no partial asset disposition opportunity available. However, if the LLC puts the roof on, the LLC does have the building on its book and does have the old roof, and it can perhaps write off that old roof and take that deduction in the current year. So kind of a completely different way to think about that transaction, a little different. So with that, I want to thank you for your time. I know everyone is real busy, so I appreciate you giving me a little bit of time to talk about these rules. If you listened to the presentation and heard some things that might apply to your company and you don't recall doing anything the year before, I'd encourage you to either give myself a call or email or talk to your Rehmann tax advisor and figure out what opportunities we might still have to do something. You might not be out at this point.
Thanks, Ryan. That was really great information that you were able to share with our attendees today. We're going to go ahead and continue on with our next speaker, which is Tracy Marin. After Tracy's presentation, we will go ahead and have our first live Q&A session with our speakers so far, Ryan, Tia, and Tracy. And then, like I said, we'll have another final one at the very end. But I will go ahead and have Tracy get started here. Tracy is a principal here at Rehmann and leads the firm's Southeast Region Tax Department. She has more than 20 years of experience and focuses on international taxation as well as tax planning and compliances for businesses and individuals. Okay, Tracy, whenever you are ready, you may begin your presentation.
Thank you, Rachel. As Rachel mentioned, I'm going to talk about some international tax topics today. These are things that you might want to be thinking about as we approach the end of the tax year. This is just going to be an overview of a couple of topics and not an in-depth discussion. If you need additional information or help, you should consult with your tax advisor, and of course, the Rehmann International Tax Team would be able to assist you with any of these issues. Today's topics include filing delinquent informational forms, W-8 documentation required by U.S. payers, and then we're going to look at entity selection decisions for investments in offshore entities. Our first topic is delinquent international information returns. There are multiple international informational forms that may be required by U.S. tax filers. Two of the most common forms are the Form 5471, the information return of a U.S. person with respect to certain foreign corporations, and Form 5472, the information return of a 25% foreign-owned corporation. Late filing penalties for these forms start at $10,000 per delinquent form. However, taxpayers have an opportunity right now to get these returns up to date without incurring the standard penalty. The taxpayer needs to demonstrate that there was reasonable cause for the delinquency. In order to qualify for the penalty-free filing, the taxpayer cannot be under IRS investigation, civil or criminal, and cannot have been already notified by the IRS regarding the delinquent forms. The 5471 and 5472 forms are filed along with the U.S. income tax return. So late forms should be filed as part of an amended income tax return along with a statement of facts regarding the reasonable cause for delinquency. As part of the reasonable cause statement, the taxpayer must certify that any entity for which the information returns are being filed was not engaged in tax evasion. If you file late forms outside of this process, in other words, without a reasonable cause statement or with a late filed income tax return, the IRS will assess the late filing penalty, and it's very difficult to get that abated once the assessment has occurred. So it's important that you go through the prescribed process. There is also penalty relief available for FBAR forms and certain other foreign informational forms. We don't know how long this opportunity for filing delinquent returns without incurring a penalty will last, so our recommendation is that you reevaluate your filing requirements and come into compliance right away if you find out that you have any missing forms. Our next topic is the Foreign Account Tax Compliance Act, more commonly known as FATCA, that came into law in March of 2010 as part of the HIRE Act. The FATCA provisions created a new Chapter 4, to the IRS Code. The objective here is to improve reporting for foreign financial assets, the carrot being used to ensure compliance is the avoidance of withholding. There are multiple facets of compliance with FATCA, including withholding requirements for certain payments made to non-U.S. persons and the requirement for individuals to report their foreign assets on Form 8938. Eventually, all U.S. entities may be required to file Form 8938, but for right now, the form applies only to individuals. FATCA imposes an additional withholding burden on U.S. payers. Withholding is required for certain payments to foreign financial institutions that do not agree to report the required information to the IRS regarding their U.S. accounts, and for certain payments to non-financial foreign entities that do not provide information on their substantial U.S. owners to the withholding agent. Withholdable payments under FATCA includes FDAP income items such as interest, dividends, rents, salaries, wages, premiums, annuities, compensation, and certain other payments from sources within the U.S. For purposes of FATCA, the withholding agent is anyone who has control, receipt, custody, or disposal of any withholdable payment. If you are a withholding agent, then you need to make sure that you have the proper documentation from the payee regarding their U.S. ownership, or you will need to withhold 30% of the payment for the remittance to the IRS. Anytime you make a payment, it is important that you know who the monies are going to and that you have documentation in place to back that up. For instance, if your payment is to a U.S. person, they should provide you with a W-9 that has their Social Security number or EIN number on it. Then at year-end, you may be required to provide them with a 1099 to report payments made to them during the year. If the payee does not provide the W-9, then they may be subject to backup withholding at 28%. If your payments are to a non-U.S. person, they will generally provide you with one of the W-8 series forms, and you may be required to provide them with the 1042-S at the end of the year. The W-8 series of forms include the W-8-BENE, which is filed by entities, the W-8-ECI, which is used to claim that income is effectively connected to a U.S. business, or the W-8-IMI, which is filled out by foreign intermediaries, flow-throughs, or branches. The W-8-BEN series forms have been revised to reflect the payee statuses under both Chapter 3 and Chapter 4 of the IRS Code. Chapter 3 addresses withholding of tax on non-resident aliens and foreign corporations, where Chapter 4 addresses the enforcement of reporting of certain foreign accounts. The old W-8 series covers only Chapter 3, while the new forms cover both Chapter 3 and Chapter 4. Foreign entities that provided a W-8-BEN in the past for purposes of Chapter 3 will now provide a W-8-BENE form for the purposes of Chapter 3 and Chapter 4. The W-8-BEN form is now used just for individuals, where the W-8-BENE form is used for entities. The W-8 forms are quite long, but the payee only needs to fill out certain sections of the form that apply to them and not the entire form. The bottom line here is to make sure that you, as the payor, have updated W-8 forms that cover both Chapter 3 and Chapter 4 in your file, and if you don't, you should request those from your payee. This requirement to have the W-8 forms in place also applies to related party payees. Our final topic has to do with entity structure for investments in offshore entities. In order to avoid a tax deadline surprise, now is a good time to look at any new offshore investments to determine what the tax treatment will be in the U.S. and whether or not you need to elect a different treatment. So the question you have to ask is, do you want the offshore entity to be treated as a corporation in the eyes of the U.S., or do you want it to be treated as a flow-through? Keep in mind that the U.S. treatment is not based on the foreign treatment. Instead, the U.S. treatment is based on the U.S. default and check-the-box rules. In other words, there is a default treatment, which in some cases can be overridden by an election. Under the default rules, a foreign entity will be taxed as a corporation in the U.S. if all members have limited liability. It will be taxed as a partnership if there are 2 or more members and at least 1 member does not have limited liability. If there is 1 member and that member does not have limited liability, then the entity will be taxed as a disregarded entity in the U.S. If you don't like the results under the default rules, you may be able to elect a different treatment. Form 8832 is used to make that election. This election cannot take effect more than 75 days prior to the date the election is filed and cannot take effect later than 12 months after the election is filed. So timeliness with this election is an important issue. In order to avoid missing the election deadline, you should address this as soon as you know you have made an offshore investment. There is late election relief available in certain circumstances, but obviously it's better to make a timely election. Just a couple things to note. There are certain statutory per se corporations where corporate status cannot be overridden by the election. Also, you can only change your status once every 60 months. And when you do change your status of the offshore entity, it is treated as a liquidation of one entity and the organization of a new entity. This transaction can have tax implications. So it's really important that you plan ahead and understand the implications of your original entity selection and any subsequent entity elections. It's much easier to deal with this issue on the front end rather than trying to find a remedy after a deadline has passed or an incorrect election has been made. So just to recap the to-dos that you might want to take away from this part of today's presentation, now is a good time to assess your international form filing requirements to make sure you're up to date and then come into compliance where necessary. Make sure you have appropriate documentation in place for all payees, including your Form W-8 forms. And finally, look at any new offshore investments to determine whether or not an entity election needs to be put in place. Please feel free to contact the Rehmann International Tax Team if we can help you with these or other international issues. And that concludes the international tax portion of the webinar. Thank you.
Thanks so much, Tracy. We're going to now take a couple of minutes and have our first Q&A session with our 3 speakers we've heard from so far, Tracy, Ryan, and Tia. If you do have any questions for any of those 3, please go ahead and submit those through the chat box. But in the meantime, we'll go ahead and get a couple of questions answered. So this first one is actually for you, Tia. The question from one of our attendees says, are you able to provide any online resources where I can obtain information on the reporting requirements for the Board of Directors and former employees?
Yeah, that's a good question. Actually, our decision reporting tree has that information for you available. So you can email us and I can send you a copy of that and it'll be spelled out really clearly for you. If you really want to dive deeper into ACA, you can always go to www.irs.gov and just in the search box type ACA and it'll pop up a screen, and if you want to look at individual requirements versus business requirements, you're going to have a whole slew of information on that website, so that's a great resource.
Okay, wonderful. And I know we do also have some resources available at Rehmann.com. If you go to Rehmann.com/Affordable Care Act, I think there's some good information there as well. All right, great. Thanks, Tia. Our next question I have here is for Ryan. The question asks Ryan, I'm a dentist. How does transfer property regulations apply to me? Okay.
Well, it's I'll speak in general terms because every taxpayer has a different situation, but immediately you'd want to make sure you're making the appropriate annual elections, particularly on that de minimis safe harbor. You want to make sure you have a written accounting policy as well so that you're writing off the smaller expenditures. Also, I know you've got a lot of heavy dental equipment likely in your office. So I would think the routine maintenance safe harbor would be important to have in place because I'm sure that's getting cleaned and inspected pretty regularly. Plus I know a lot of that equipment is pretty expensive, so the repairs could potentially be sizable. So you'd want to be taking a look at those. In addition, depending on if you own or lease your space, there may be some, and what you've done to it, there may be some opportunities there either in the past or in the future. You know, we'd be happy to look at your individual situation to see what we can do. But in general, those are my thoughts on things that will apply directly to you.
All right, great. Thanks, Ryan. And the next question we have is for Tracy. Tracy, the question says, when are the W-8BEN forms due to the IRS?
Well, the W-8 forms are not actually sent to the IRS. The payee prepares those forms and provides them to the payor, and the payor just holds them in their file. The payor needs to be prepared to provide those to the IRS if there is an IRS audit, but otherwise they do not go directly into the IRS.
All right, great, thank you. I think we'll have time for one last question, and this one is for you, Tia. The question says, for 2016 ACA, my understanding is that affordability is still single coverage less than or equal to 9.5% of the annual W-2. Is that correct?
Changed slightly for inflation. I would have to look up what that new percentage is, but that is one of the safe harbors. There's 3 safe harbors allowed, and that's one, and then there's a poverty level. So email me and let me get you that percentage for 2016 because I do believe it's changed slightly.
All right, great. Thank you, Tia. And we'll certainly, for the person who asked that question, Peggy, we'll make sure you and Tia are able to connect after our webinar. But thank you all very much for the questions so far. We're going to continue on with our next set of speakers. We're going to start here again with our next topic, which is net investment income tax planning with our advisor, Diane Ferris. Diane is a principal within Rehmann and provides corporate, partnership, and personal tax return preparation services, specializing in small to medium-sized enterprises and their owners. Diane also provides non-traditional services, including transactional planning, such as acquisitions and mergers, systems and process development, and growth management. Okay, Diane, whenever you are ready, you may go ahead and begin your presentation.
Good afternoon, everyone. My presentation is NIT for the WIT, the net investment income tax. And here is the only part of the presentation that will be WIT. The IRS, like the sign says, it's all theirs. Our session objectives, I'm going to briefly overview the 3.8% Medicare surtax, better known as the net investment income tax, and how it pertains to individual taxpayers. The opportunities, discussing planning ideas for reducing either modified adjusted gross income or reducing investment income to reduce the net investment income tax. Planning opportunities for the individual who owns various and multiple business interests, and then we are going to conclude. The net investment income tax, the overview is, it was effective January 1st of 2013. So it's been in effect for your tax returns for 2013, 2014, and now 2015, this closing tax season coming up. A taxpayer in the 39.6% tax bracket has effectively increased their tax rate to 43.4% if they're subject to the net investment income tax. For our high net worth individuals, this is a significant increase in their marginal tax rate and is in effect adding another state tax liability to their overall tax rate and tax liability. The net investment income tax and the additional Medicare taxes on compensation income may apply to the same taxpayer in the same year, but not to the same types of income. If the net investment income tax applies to your income, then the Medicare tax will not, and vice versa. You'll pay either the Medicare tax or self-employment tax on the income and then not pay the NIT The net investment income tax is equal to 3.8% times the lesser of either net investment income or the excess of modified adjusted gross income over the threshold amount. So there are three key terms to become acquainted with when you're thinking about the net investment income tax. They are net investment income and how that's defined, the threshold amount, and then the modified adjusted gross income definition. So there are only two ways to reduce the amount of the net investment income tax that you pay as an individual taxpayer. You either reduce the amount of net investment income or you reduce the amount of your modified adjusted gross income. So first, net investment income. It includes your taxable interest, dividends, annuity income, distributions, rents, passive royalties, income derived from a passive activity, and we'll discuss that more later, or net capital gain derived from the disposition of property. Net investment income does not include wages or any other form of compensation, distributions from your IRAs or qualified plans, any income that is subject to self-employment tax. Remember, you only pay one of the two taxes, you do not pay both. Gain on the sale of an active interest in a partnership or S corporation, and items that are otherwise excluded from taxable income. Second, the threshold amount. The key factor in determining the lesser of formula is the threshold amount. The threshold amount is for single taxpayers, $200,000, married taxpayers and surviving spouses, $250,000, and married filing separate taxpayers, $125,000. Third, the modified adjusted gross income and its definition. Modified adjusted gross income is the amount that is compared to the threshold amount to determine the net investment income that is subject to the surtax. Your modified adjusted gross income is your adjusted gross income from your Form 1040 and net foreign earned income exclusion amount. Basically, for the majority of taxpayers, the modified adjusted gross income amount is equal to your AGI, your adjusted gross income from your Form 1040. So let's talk about a couple examples to make these examples more clear to what we're talking about. The first example, he nitwit is a single taxpayer. He has $100,000 of wage income and $50,000 of net investment income. That could be dividend income, interest income, any of those types of income that are investment type income. So his modified adjusted gross income is $150,000 in this example. So the 3.8% surtax, the NIT, would not apply because the modified adjusted gross income is less than the threshold amount, which is $200,000 for a single taxpayer. Example 2, she nitwit, she is also a single taxpayer. She has no wage income but $225,000 of net investment income. Her modified adjusted gross income is $225,000 plus her threshold amount of $200,000 equals $25,000. That's the excess of the modified adjusted gross income, again, over the threshold amount. So the 3.8% NIT would apply to $25,000. Example 3, we have spender and saver, a married filing joint return taxpayers, $400,000 of combined wages, $50,000 of net investment income. So the modified adjusted gross income in this example is $450,000. The threshold amount is $250,000, which equals $200,000. So the lesser of $200,000 or the net investment income of $50,000 is the amount that is subject to the net investment income tax, which means the 3.8% surtax would apply to $50,000. Balanced in budget, also filing a joint return, $200,000 of combined wages, $150,000 of net investment income. In this example, our modified adjusted gross income is $350,000. The threshold amount is $250,000 for married filing joint taxpayers. That equals $100,000. The lesser of the $100,000 or the net investment income of $150,000 is what is subject to the net investment income tax, and that would be $100,000. Irene Renee Smith, she's known as IRS to her friends. She's a single taxpayer. She has $200,000 of net investment income, $125,000 of a required minimum distribution from an IRA account or pension income or tax-exempt interest income. Modified adjusted gross income is $325,000, the threshold amount $200,000, $125,000 is the balance, and so the lesser is, in this example, $125,000 as compared to the $200,000 of net investment income that she has. So the net investment income tax would apply to $125,000. Opportunities then. Remember from a previous slide, the opportunities to reduce the net investment income tax would be to reduce your modified adjusted gross income or reduce your net investment income. Here are some examples of how to reduce your modified adjusted gross income. Roth IRA conversions if you're planning on having lower taxable income in the long term because your Roth distributions when taken are not taxable. Charitable remainder trusts, split interest trusts, where you have an income interest and a remainder interest that goes to charity. Again, these strategies are in order to reduce your modified adjusted gross income each year over the long term to be under the threshold for when you are a single or a married filing joint taxpayer. Non-grantor charitable lead trusts are also a nice way to do that. Split interest trusts, they consist of an income interest with the remainder interest and the income going to charity. Installment sales. An installment sale takes a sale of your property and spreads the gain from that sale over several years going forward in the future. You can also maximize contributions into your retirement plans, your 401k plans, your SEPs. Those types of contributions into those plans reduce your income because they are not taxable to you as compensation income in the current year. Another way to reduce your modified adjusted gross income is to look at like-kind exchanges if you sell property and you would like to defer that gain. The other opportunity then would be to reduce net investment income. Investments that do not produce income subject to the net investment income tax. So if income is not subject to federal income tax, then it will not be subject to the net investment income tax. Examples of that type of income are municipal bonds, tax-deferred annuities, life insurance, rental real estate, oil and gas interest, but special rules do apply to those types of investments. Non-passive business income, which is income derived from an active trade or business. Non-passive gain, that gain from the disposition of property that is also held in an active trade or business. Planning opportunities for the business owner. A lot of our clients are business owners and they have multiple interests in S corporations or partnerships, and I've talked a little bit about the active versus passive, and that becomes very important when you're trying to escape the net investment income tax. So income from a passive trade or business is net II, net investment income, which is subject to the net investment income tax. So if a taxpayer materially participates in the ordinary course of a trade or business, the income is not subject to the net investment income tax. Ordinary course of a trade or business, this is a key term. Ordinary course of a trade or business basically means carrying on a trade or business, and rental is not carrying on a trade or business. A rental activity is automatically treated as a passive activity under the passive activity loss rules. So for purposes of the net investment income tax, it is necessary to determine whether or not the rental constitutes a trade or business under the code section that actually defines carrying on a trade or business. Here's an example. Portfolio income, and this example does apply to quite a few of our clients. Portfolio income, like interest, derived in the ordinary course of a trade or business. So this partnership or S corporation actually carries on a trade or business, and the S corporation or partnership charges interest on customer receivables. The question becomes, is that interest that shows up on your K-1 on the interest line subject to net investment income tax or not? If the partnership or the S corporation has interest from the customer receivables and the owner is active in the trade or business, then that interest income is not going to be included in that investment income. And the reason is because that interest is actually earned in the business of the partnership or S corporation. So that interest would be better reported in the income line of the tax return and not on the interest line on your Schedule K-1. The interest on the Schedule K-1 should be interest that's earned on bank accounts and such, because that income is going to be subject to the net investment income tax, whether you are active in the business or not. If you are not active in the business, all of the income that shows up on your Schedule K-1 is going to be subject to the net investment income tax. Materially participates. Key terms in this is active and passive. Where a business is conducted through a partnership or an S corporation, the determination of whether the business is active or passive to the taxpayer is made at the partner or the shareholder level. Whether or not you are carrying on a trade or business is determined at the entity level. This part is determined at the individual level. Material participation defined. These 7 tests probably are not new to anyone. So for individuals, you need to satisfy one of these 7 tests in order to be considered materially participating in your trade or business, to have your income be characterized as active and not subject to the net investment income tax. The most popular one of these 7 is participating in the business more than 500 hours per year. Some of the other ways you can materially participate are in items 2 through 7. Participation is substantially all of the activity of all individuals participating more than 100 hours, and no other individual participates more. Activity is a significant participation activity, and the individual's aggregate participation in all significant participation activities exceeds 500 hours, and we're going to talk a little bit about that more so in upcoming slides. The individual materially participated in the activity for the past 5 of 7 years. The activity is personal service activity. Personal service activity is law, engineering, medical, professional services. And if you've participated in that activity for any of the 3 preceding taxable years, you are considered as actively participating. And then the last one is based on all facts and circumstances. The individual participates in the activity on a regular, continuous, and substantial basis during the year. Material participation, activity grouping. You've probably heard about this a little bit since the net investment income tax came into play in 2013. The question became to group or not to group. Grouping of activities, you can group activities to meet a material participation test. But in order to group your activities together, they must be aggregated if they constitute an appropriate economic unit. And so that is determined based on the colored boxes below: geographic location, common ownership, common control, similarities and differences in the type of business, and then business interdependencies. If you have some of these characteristics within the multiple business interests that you may own, you may be able to group your activities in order to determine material participation with the group, as opposed to trying to work 500 hours in each of the activities that you own, which becomes a very daunting task since you run out of number of hours in the day. So within your business activities, you also want to identify income that is not subject to the net investment income tax. Self-charged and incidental rental income, those are basically if you are renting to yourself, you have a business adventure that rents to another trade or business that you own, the income that is self-rental would not be subject to the net investment income tax. And self-charged rental is if you meet one of the tests under the passive activity loss rules for whether or not your rental activity is substantial or insubstantial to your trade or business activity. In those cases, then your income from your rental activity, even though rental income is per se passive, you may escape the net investment income tax because it qualifies under one of these rules. Here's an example of the self-rental rules. You have entities A and B, and A is a trade or business activity, B is the building rental, and you're paying rent. If the taxpayer is a member of A and A is an active trade or business, the taxpayer is also a member of B that owns the building and rents the space to various tenants, and one of those tenants is A. The taxpayer doesn't necessarily materially participate in the rental activity, but because of the self-rental rules, the rent basically being paid to himself or herself is not net investment income and not subject to the net investment income tax. Another similar concept in this arena is self-charged interest. So a taxpayer who lends money to a pass-through entity in which the taxpayer materially participates is only going to be subject to net on the interest payable by the portion of the entity allocated to the other investors. So just like the self-rental, the self-charged interest is not going to be subject to net investment income tax for the taxpayer who basically loaned the money into the organization and the organization pays interest back to him. That portion is not going to be subject to the net investment income tax. Here's an example of the self-charged interest rules. Trade or business activity again. A loan made by one of the members in the LLC, interest being paid by the LLC to that member. There's a calculation that needs to be done because the taxpayer can't exclude all of the interest being paid to them, only the portion of the interest being paid to them for the ownership interest that they own in the LLC. Identifying income that is not subject to net investment in real estate. Rents, as I said before, are from real estate activities, are per se passive, and that's per se passive under the code section that gives us all the definitions of what the income is subject to net investment income tax under the passive activity loss rules, and that's section 469. But there is a safe harbor for real estate professionals. Real estate professionals is a very narrow and small area for certain of our clients and prospects to escape the net investment income tax if they can fall within this very narrow definition. So this is not a broad application. To qualify for a real estate professional, more than 50% of your taxpayers' work is in a real estate trade or business, meaning they could be a broker or a property manager, something like that, and then the taxpayer performs more than 750 hours during the year in those real estate trades or businesses. Then you will be considered a real estate professional. If you are considered a real estate professional, then there are some safe harbors for if you also own rental property. Remember, rental property is per se passive, and rental income would be subject to the net investment income tax. If you are a real estate professional, there are opportunities for you to escape the net investment income tax on your rental income if you qualify under these safe harbors. Here's a brief description of the real estate professional and how the rules apply. If the investor is not a real estate professional and the income is not derived in trade or business, the rents would be subject to net investment income tax. If the income is paid from an active trade or business of the investor, the self-charged rule, then no, their rents are not subject to net investment income tax. If the rents are properly grouped, we talked about grouping with an active trade or business, then the rents are not subject to the net investment income tax. Now, if the real estate professional rules apply, but the income does not qualify under the safe harbor, then yes, the rents are still subject to net investment income tax. If the investor does qualify for the 500-hour safe harbor rule, then the rents are not. And if the income is derived from a trade or business of renting property, then the rents are not. Significant participation activities. This area provides a tremendous opportunity for our clients to take a look at what activities they are owners in and how much time they spend in each activity. A significant participation activity is the trade or business in which the taxpayer participates for more than 100 hours but less than 500. And our taxpayers can have multiple significant participation activities, and they all need to be looked at, and you need to look at the number of hours that you are working in each activity so that this determination can be made when your tax return is prepared. If we assume a taxpayer has 3 significant participation activities, activity 1, 175 hours, activity 2, 200 hours, and activity 3, 150 hours, then this person works more than 100 hours in each of the activities and more than 500 hours in total. So together, the taxpayer meets the material participation requirement for all 3 significant participation activities because they're grouped together, and so all of the income losses are non-passive and not subject to the net investment income tax. Recharacterization rules. The passive loss rules do include a special rule for significant participation activities, which does recharacterize income but not losses from a significant participation activity. This is where a taxpayer participates for more than 100 hours per year in the activity, but less than 500 hours together, and then part of the income will be recharacterized as not passive and then not subject to the net investment income tax. Here's a participation summary. Material participation, more than 500 hours. Significant participation, 101 to 500 hours. And then neither 100 hours or less, then your income is passive and subject to net investment income tax, and losses are still passive. So there are basically 3 buckets that you can drop into. Here are recharacterization rules and example. 2 activities that the taxpayer has. Activity 1 has income and deductions, net income of $400. In activity 2, we have income of $200 and deductions of $500, so we have a net income of $300. So together, we have a net income of $100. The recharacterization rules, this is a very special rule and one that we take very close attention to in preparing your tax returns. You have to calculate how much of the income is going to be recharacterized to non-passive and how much of the income remains passive. Basically how this rule works is that if you work more than 100 hours in both activities but less than 500, the IRS says we have to recharacterize income from passive to active, but not the losses. So in this example, what happens is we end up with $100 of income remaining passive that offsets the passive loss, and the rest of the income gets recharacterized as non-passive by rule of law. Once it is determined to be non-passive by the rule of law, by this example, then that income is not subject to the net investment income tax. So it was an unintended consequence by the IRS and the regulations under the passive activity loss rules to limit taxpayers from deducting passive activity losses, and in effect, they gave us a great escape for getting out of the net investment income tax. But what we need from all of our clients and taxpayers in this regard is we need to know the number of hours you are working in every activity so that we can determine how to recharacterize your income in preparation of your tax return. Planning opportunities for the business owner. There is some restructuring opportunities to avoid the net investment income tax. The regulations do provide that if income is subject to self-employment tax, it is not subject to net investment income tax, and vice versa. S corporations, flow-through income from an S corporation, the income that you receive on your Schedule K-1, is not subject to self-employment tax as long as the owner receives reasonable compensation. In a partnership, general partnership or limited partnership, a partner's distributive share of trader business income is subject to self-employment tax, but there is an exception for a limited partner in a limited partnership. And LLCs, income flowing through an LLC, a limited liability company, income flowing through to an LLC member who participates in management will most likely be subject to self-employment tax on their distributive share of income, the income that shows up to you on your Schedules K-1s. But planning opportunities do exist for a manager-managed LLC if the LLC owner is not a manager. Conclusions. We need to be aware of your amounts of your net investment income and your modified adjusted gross income to determine, first of all, if you are subject to the net investment income tax. If we have opportunities to reduce your net investment income or to reduce your modified adjusted gross income below the threshold amounts, then we can avoid or escape the net investment income. If we know what your investments are and what type of income they produce, meaning tax-exempt income is not subject to the net investment income tax. So a review of your investments in portfolio can also reduce or eliminate your net investment income tax. If you are a business owner, we need to know if you are active or what it takes to be active in the trader business to assist you in determining whether or not your activity is passive or active to you and whether or not it is subject to the net investment income tax. Do you have self-rentals? Are you renting to yourself? Can you increase your rent? Are you paying market rent? Do you have self-charged interest? Do we know if you have loans to your company and the amount that you are paying in interest? So what we'd like is that you look at the Schedule K-1s that you do receive, and do they provide the information from your CPA to accurately prepare your tax return? If they don't have all the information necessary to make these determinations, you may be paying more tax than you should. Do you qualify as a real estate professional? Does the safe harbor rule apply? Do you have significant participation activities? This is a very important area to concentrate on, where your activity may not be material in an activity, but it may be significant, more than the 100 hours. Are there any restructuring possibilities? Do you have LLC ownership interests? And can we convert some of your LLC interests to manager-managed versus member-managed? That makes a significant difference in determining whether or not you are subject to the net investment income tax. And the last item, keep your wits about you. Your CPA can help. And that concludes my portion of the webinar.
Thank you very much, Diane. Greatly appreciated. That was really good tips and suggestions you have. We're going to continue on with our final topic and presenter for our webinar today. Our topic is going to be cybersecurity and will be presented by advisor Jessica Dory. Jessica is the Senior Manager of Technology Risk Management for Rehmann Consulting. She specializes in information technology consulting and security and has extensive experience performing IT security assessments for multiple institutions throughout the country. Okay, Jessica, whenever you are ready, you may begin your presentation.
Wonderful. Thank you, Rachel, and good afternoon, everyone. As Rachel said, I'm going to be talking about cybersecurity and the different threats that are out there. I'm sure many of you see in the news all of the breaches that are happening. So What we want to do is be able to give you some information so that you can protect your organization against any type of data breaches or compromises. So the pace of change is picking up. Data is exploding. It's just continuing to get bigger. Communication is changing. The way we interact is changing. We have all the new social media concepts coming in play. Processes are changing. We're connected 24 by 365 by 7. With all of this connectivity comes risk, and that's what we want to talk about today, is the risk that's out there from a cybersecurity perspective, and then also talk to you about some of the controls that you can have in place to make sure that you're best mitigating that risk. This slide really kind of talks about fraud, cybercrime, and the bottom line, and how fraud and cybercrime is affecting organizations these days. $400 billion is lost annually to fraud and misappropriation by U.S. organizations. 6% of annual revenue is lost to fraud and abuse by the average organization. And $5.4 million is the cost to resolve the average data breach, which doesn't include liability issues after the fact. So huge amounts of money that is being spent on all of the fraud and cybercrime that's occurring these days. Cybercrime is here to stay. There's cyber warrior mercenaries for hire worldwide. It's a multi-billion-dollar underground economy. Cybercrime is an industry of suppliers, distributors, and manufacturers, and they're trading information. It's continuing to grow. The hackers are just multiplying by the day. So it's not something that we're ever going to see go away. It's just we're going to have to deal with it better. 60% of organizations fail within 6 months of being hacked. This is because of loss from cash from bank accounts. If a hacker was able to get in and your organization is doing any kind of online banking transactions through your financial institution, they're able to wire and ACH money out of those accounts. That's essentially leading to the cash being stolen from the account. There's cost of breach, repair, and recovery if you do have any type of breach, cost of notification, compliance, lost customers and clients, and cost of reputation loss is huge. You know, if you were to experience any type of breach or compromise, it tends to be in the news. And the last thing you would want is essentially being in the news about a breach that occurred and then have that reputation loss. Small organizations are a big target. Some of the reasons why are small organizations don't think they're going to be attacked. They think they're too small. They think that the hackers are going to attack the bigger organizations and not. The truth is that they don't care, hackers don't care what size the organization is. They're just trying to get in and either get sensitive information or get money out of your bank accounts. Cybersecurity is not a priority for a lot of small organizations. There's weak cybersecurity and outdated tools, poor employee training, poor no data response plans, and small organizations tend to lead to bigger targets. So essentially, you know, with a lot of the breaches that occurred, you know, some of them stemmed from a small organization being hacked and then used to be able to get into a large organization. Some of the major cyber attacks that happened over the past few years, you know, you can see from the amount of records here, a lot of people are very familiar with many of these, the Home Depot, the Target. Lots of information was lost in many of these breaches. And so we just want to make sure that, you know, your organization doesn't become one of these. The cost of an average cyber breach, like I had said in the slide earlier, the average cost is about $5.4 million per breach. Each lost record averages about $188. Disruption alone costs typically cost an organization almost $1 million per breach. The disruption costs come from employees having to deal with the breach and the cost of their time and having to go through that and deal with it. And then you have all the liability issues for identity theft and everything else that would occur. This is a cybercrime toolkit. These are examples of the tools that the hackers use to be able to get into an organization or to attack an organization. denial of service attacks, malware, spyware, ransomware, keylogging, phishing and farming, and social engineering, bots and Trojans and viruses. These are all of the tools that they use to try and compromise the average organization. Some of the social engineering scams that are out there, an email appears to come from you. An email appears to come from your internal staff. You get a message saying, you know, from a friend, it appears to come from a friend overseas and in trouble. The Nigerian email scam that we've all seen. Your tax refund is already taken care of. Many of the social engineering schemes relate to tax refunds, and whether one being that you owe tax, additional tax money, or the other one being that you have a refund waiting and go ahead and click on a link to claim it. It's very easy to spoof an email address. So just because an email looks like it's coming from a specific person, don't always believe that to be true. You know, don't stay away from clicking on links in emails that could download malicious software to your environment. Here's an example of a social engineering email. This one comes from Verizon. It looks like it's coming from Verizon. They've done a good job at spoofing the email address. This one here is basically an account statement. And what they do is they have the total balance being almost $1,000. So what they want you to do is essentially have that knee-jerk reaction. You know, oh my gosh, my bill is almost $1,000. I need to click on this link that they put in here and figure out why my bill is so much this month. Well, as you can see, if you hover over the link doesn't go anywhere related to Verizon. So essentially, they're trying to get you to quickly click on that link, and then they can install their malware onto your machine. Ransomware, this is another popular scheme that's been happening. Basically what happens is hackers will send emails containing links that have malicious software related to them, or also attachments to emails. When you click on that link or download the attachment, they then are able to take your data hostage. And what I mean by this is they're able to get into your system, and then they go and encrypt your files on your network. Then you'll get an email, basically a ransom email, saying, we've encrypted your files. If you want them unencrypted or back, then you need to pay us a certain amount of money. They start out with a number. It continues to get bigger. A lot of organizations that this has happened to, if you have a viable backup in place, you can restore from before the malware entered your environment and they were able to lock down those accounts. So having a backup, which we'll talk about later as a key internal control, is very important, because if you get infected with any type of ransomware, that's going to be your best bet to be able to get your data back. So what do they do with the information when the hackers have it? They sell it. They sell it to people who want to open false bank accounts, file false IRS returns, open false credit cards, steal from bank accounts, and hack into other accounts and businesses. Employees of your organization are unfortunately the weakest link. Negligent insiders are the top cause of data breaches that occur. They click on links in emails. They send work email to personal accounts. They use data on insecure lines. They don't follow corporate policies, and they don't secure mobile devices appropriately. So unfortunately, what you have to do is make sure that you're training your employees appropriately so that they aren't the weakest link, because that's where the hackers are going to. They found that a lot of, the IT departments have appropriate controls in place, so they're using the employees as a way to get into the organization. Some of the things from a weak IT security perspective that are a vulnerability are poor access controls, poor patch management, improper device configuration, lack of security audits, and weak enforcement of remote login policies. So a lot of organizations don't have these types of controls in place, which then essentially leads to a weak IT environment. So now we're going to talk about where you should focus. These are some of the areas, and we'll go through each of these: data, perimeter, access, governance, vendor, mobile, human. And we'll talk about some of the controls from each of these areas that you should have in place in your environment. So data management. Have you identified what data you have, where it's stored, and what it's worth to someone from the outside if they were to get it? Have you identified your access paths, how you can get to the data, and what are the control points to get there? Have you identified who can get to your data? Perimeter management. Have you implemented a firewall? And do you have a DMZ, demilitarized zone set up? These are very key parts of a network perimeter. Have you segregated your network? Is the network virtualized? Do you leverage VLANs to segregate the network so that if a hacker was to be able to get in, that they wouldn't be able to take over the whole network, that it's specifically segregated so that you have basically gates in place to block them at certain points? Intrusion detection and prevention. Do you have an intrusion detection and prevention system? Have you turned the alerts on, and are they being monitored? We see so many organizations that have these tools in place, but they're not monitoring the alerts that are coming from them, which is a key component, because if you have somebody monitoring them, you understand when you're potentially being attacked by a hacker. Are you regularly conducting vulnerability and penetration testing and social engineering testing? That means having someone come in, such as Rehmann, do an external vulnerability and an internal vulnerability and penetration test to see if your organization is vulnerable from the external perspective, and then also from the internal perspective, which would simulate a disgruntled employee trying to wreak havoc on the internal network. Have you done social engineering testing of your employees to see what type of risk are you at for employees clicking on links in emails and entering potential sensitive information? And as I said, Rehmann can fully assist with these. Access management. Access controls, do you have those in place? Have you restricted administrative access to the environment? Do you perform regular reviews of access to make sure that only individuals have the appropriate access they should? Do you leverage least privilege? That means, do employees only have the job functions, the access that is specific to their job and none in addition? Software patching. Are you regularly patching both Windows software and also third-party software, which would be like Java, Adobe, things like that? Best practice recommendation would be at least every 30 days from a patching perspective. Backups, we talked about this earlier. Are you doing daily backups? You should be. Are you rotating them off site and testing the backups to make sure that the backups are truly viable and that you would be able to restore to a backup in the event you needed to because of a disaster or incident that happened? Vendor management. Are you doing regular reviews of your third parties that are involved when you're selecting a new vendor, when you're doing contracts with the new vendors, and then for any critical vendors that have any type of access to your internal environment? Are you doing a regular annual review of those vendors to make sure that they have the proper controls in place? Many outsourcing type vendors from a technology perspective will have what's called SSAE 16 performed, which is an audit of their controls if they're doing any type of data processing for you. The cloud. How do you know you're making the right decision to go to the cloud, and what types of things are you making sure that you have in place? When you're talking about the cloud, one of the biggest things here related to this is also vendor management, because you need to understand where your data is going to be stored with any of these cloud vendors. Who's employed by these cloud vendors, and where is my data going to be kept? Security. Have you identified an individual or your organization to be responsible for security? Storage. We talked about this as well too. where's all your data stored? And do you know where all your data is stored, both at your location and at any third parties that are storing any type of data for you as well? Mobile. Mobile devices are continuing to grow, continuing to become more advanced. Have you defined a mobile device strategy? Do you have the appropriate acceptable use agreements in place? Are you forcing any type of authentication and encryption if these mobile devices are being used to connect to your internal environment? Making sure you have a secure transmission and device management. If you have a number of mobile devices that are connecting to your environment, you should have a mobile device management software in place so that you can appropriately wipe those devices in the event that they become lost or stolen. Have you done employee training to make sure employees are aware of the risks that are associated with mobile devices and how to properly secure those devices? Training. Are you doing training for users, your employees, on information security programs, incident response plans, business continuity plans, and security threats? You should make sure that you're constantly training your employees and your users about the threats that are out there. So basically, to kind of close it all here, close all the loopholes, you should create and enforce security policies. You should educate your employees, update your security software, back up and encrypt your data, secure your devices, purchase cyber insurance, and have an IT security assessment performed. And again, that's where Rehmann can assist you with that. So in the end, we want to be proactive in making sure that you're protecting your organization from the threats that are out there and not have a breach occur and have to be reactive. So with that, I want to thank you for your time today, and I will turn it back over to Rachel.
Thanks so much, Jessica. That was really great tips and information you were able to provide to our attendees today. All right, we are going to spend the next couple of minutes here answering some additional questions that we have received from our audience. So we do have all of our speakers that you have heard from today available. So as we are going through, if you do have any additional questions you'd like to get answered, please go ahead and submit those through the chat box. But we will go ahead and get started with all of our speakers. So the first question I have actually is for you, Jessica. The question is, how often do you recommend backing up your data?
On a daily basis, backing up your data on a daily basis so that you're not losing any work that's done significantly throughout the week.
All right, great, thank you. Diane, this question is for you. The question says, I have some expenses related to rental income. Is that deductible for this NIT from the WIT?
NIT from the WIT. Yes, when you file your tax return, you are reporting your rental income as an individual on Schedule E in your Form 1040, and then the amount that is subject to the net investment income tax is the net income, not the gross income. So your gross income is reported on the Schedule E less deductions, so it's the bottom line net. You are allowed to take those deductions.
All right, great, thank you. Ryan, we actually do have another question that has come in for you. The question is there a particular industry that may benefit more from these rules?
Well, I think the rules apply to everyone, whether it's a matter of just making elections on an annual basis as needed. We have seen some of the biggest opportunities apply in real estate, both on owner-occupied buildings and commercial real estate. So while I think there's some opportunity out there for everybody, I think the largest opportunities are dealing with real estate.
All right, great, thank you. Diane, I do have one additional question for you from our group today. The question is, where do I find out how much net investment income tax I paid on my 2014 tax return?
The net investment income tax is reported on Form 8960 in your Form 1040. So if you flip through your 1040, if it's in paper or if it's on PDF, it's the Form 8960. And you would then go all the way to the bottom of that page, and the tax that you are paying is reported on line 21. So it would be a good idea to just take a look at that and see if you are paying a significant amount of net investment income tax, and then contact your business advisor to talk about planning opportunities in order to reduce that.
All right, great. Thank you, Diane. We do have one question here for Tia, who had spoken earlier today. The question actually was from earlier. I know, Tia, you had mentioned you would like to just kind of continue that question and provide some additional answers. The question was, for 2016 ACA, my understanding is that affordability is still single coverage for less than or equal to 9.5% of the annual W-2. Was there anything additional you wanted to mention about that, Tia? Tia, are you still there? All right. Well, we will go ahead and get that question answered from Tia after the webinar. We'll make sure to circle back with that attendee who did ask that. But in the meantime, we will continue on. Diane, I do have another question that has come in for you. The question says, are winnings from the FanDuel subject to NIT? And then it has another question for Southeast Tax. I think that's what SE means.
FanDuel, someone's out there playing fantasy football and winning? I've got to get some tips on how to do that. The gambling winnings are taxable income, and if you are not in the trade or business of being a gambler, then that would be considered investment income, and I believe it would be subject to the net investment income tax.
All right, great. Thank you so much. It's definitely an important question to ask.
Yeah, I don't know anybody with winnings.
I know. There is someone out there.
One person.
I know. All right, Jessica, I do have one question for you as well. The question is, can you talk just a little bit more about enforcing security policies? Sometimes it's difficult to tell people just how important it is and why they shouldn't be clicking things all over the place.
Right, yes. Oh, absolutely, yes. It's very difficult to enforce security policies, but a lot of times what our clients do is they have us do some of the social engineering testing related to people clicking on links and things like that. Use the results from that testing to then be able to, what I'd say, force the point home more, you know, make sure that employees are aware of what can happen if they click on a link. So they use that testing that we do as incorporating that into highlighting to employees the proper policies that need to be followed. So that's one way our clients have been able to do that. But yes, it is a challenging task to keep employees from clicking on links. I can appreciate that.
All right, great, thank you.
Mm-hmm.
We do have one question for Tracy. Tracy, the question says, a little delinquent with internal information form, and the IRS has already contacted me. What would count as a reasonable cause you mentioned?
Well, the IRS has already contacted them about the form. Is that what you said?
Yep, that's what it looks like. Yep.
Okay, if the IRS has already contacted them regarding the delinquent form, then they are not going to qualify under the program right now that allows you to file them without getting a penalty assessed. Having said that, it probably makes sense for them to try to write a letter to the IRS explaining the situation and why the form was delinquent. Some of reasonable cause is a facts and circumstances type of situation. So basically you have to tell why the form was late. Hopefully it's the first time that the form was required to be filed. In that case, that can be part of your reasonable cause explanation, is that you were a first-time filer, you didn't know that the form was required to be filed. And then any other circumstances that would have kept you from filing. Another thing I always like to include in those letters is a statement regarding how going forward we have a system in place to get the returns included. You may not have success the first time you send the letter. I think the IRS tends to automatically come back and deny those, but you may have success sending a follow-up letter. We've dealt with that where we've gone directly with the IRS and tried to get some of these penalties abated. So if you, and sometimes it's a negotiation, sometimes we can't get the whole thing abated, but we can get a portion of it abated. So they may want to contact us about going directly to the IRS on their behalf.
All right, great. Thank you very much, Tracy. Diane, I think you had mentioned you wanted to comment something regarding one of the questions that came in.
Right. Let's go back to the gambling winnings. Originally, when the net investment income tax first came out in 2013 and the regulations were issued, they did not address, the IRS and the regulations did not address gambling winnings, lottery, and some of the other types of income that you could receive. So they did not address it back then. I believe you still need to go back to whether or not it's a trade or business and whether or not it's investment and whether or not you have the net income from gambling winnings. I haven't seen anything recently definitively saying yes or no on that, but if we do find that, I can get it posted probably on the Rehmann webpage to answer that question, but I haven't seen anything direct in regards to that.
All right, wonderful. Well, I do want to go ahead and thank everybody for coming in today. If you do have any additional questions that we weren't able to answer, please go ahead and email those to us at events@rehmann.com, or you can certainly contact our advisors directly. Their information is here on your screen. If you'd like to learn more about Rehmann, please visit rehmann.com. And this concludes today's program. Thank you all for joining.